All right. Thanks, David, for having me again. And we're going to cover a lot of ground today. We're going to look at options trading using some automation and proprietary technology that actually creates these professional strategies for you. And then we'll actually manage the risk and the profit. We call that autopilot. We have some unique trade alerts as well. You'll never have to try to copy a trade alert again. You'll just touch accept or reject, and that's all you have to do. So we think we can save you a lot of time, and we can tell you a little bit about which rookie strategies to avoid and what we think you ought to do instead. And it's not just automation, but we're real people. And just like Marina said in her last presentation there, she makes herself available for coaching, and we do the same thing as well with options. So we're going to tell you about that here in just a second. But before we jump into that, remember we're speculating. There's always risk when you speculate and try to generate a profit. There's always risk. So do take a look at our risk disclosure. That's required for compliance purposes. And you might want to take a screenshot of that if you want to read every word. I encourage you to do so. Remember, there's always risk involved when you're trading, and past performance is never a guarantee of future results. Okay, a little bit about AltaVest. We've been doing this since 1997. We're a registered introducing brokerage firm. So for 27 years, we've been serving our clients, trading tens of millions of contracts along the way. That's yours truly there in some of our colleagues and business partners on the S&P 500 options pit. Some of our brokers that would fill all of our trades for us. But of course, it is no longer like that. That's because the machines have taken over, and we're gonna show you that in just a minute. We created a Dragonfly option strategy and our proprietary order execution technology to make that happen. We're going to show you that as well. Because we're a brokerage firm, we're obviously regulated, like I mentioned, but we're registered with the CFTC and also members of the NFA. We're located in California. It's possible you've seen us around on other presentations, and we often get quoted in publications and newsletters as well. For example, here's Market Watch just this last month talking a bit about gold, talking about buying a pullback in gold here. Another mention here, April 16, talking to us about, turns out they like talking to us about gold sometimes. So anyway, and I am Erik Gebhard. I'm a co-founder of AltaVest. I graduated from University of Southern California. It seems like a long time ago, but got my business degree from there. I've had multiple securities licenses over the years in mutual funds, annuities, insurance. Currently have my Series 3 commodity futures license and the Series 65, which is for investment advisors. So we're going to jump in here and let's see if you can relate to these three barriers or hurdles that might be in your way as a trader. So number one, how about simply put noise and confusion, narratives, opinions, conflicting price targets, a lot of clickbait headlines in the media. This one here, I've left it up here for a couple years now, actually, just because I don't know, for some reason it seems so absurd that this would even make the headlines. This guy says Bitcoin's either going to 250,000 or 5,000 next year. So as if that is somehow useful information. Anyway, so I don't know why that would even get published. And then this is just a week ago. Someone pointed out that Jim Cramer back in April, when the stock market was dropping, he was suggesting that we're on our way to another Black Monday stock market crash. And that turned out to be the exact bottom. And we've rallied here, what, 25% or something on the NASDAQ since that point. So not to pick on him in particular, but that's just making the bigger point that there's a lot of conflicting opinions and noise out there. How about this other barrier? And let me know. You can put things in the chat. I can't always respond right away, but let me know if you agree with these barriers or if you can relate to them at all. But time. So you need a lot of time and discipline to be able to screen watch. You know, it's a lot of variables to keep track of. Not many people have time for this type of thing. And if you do and you can make it work, that's fine too. But for a lot of people, they have schedules that just don't permit kind of that screen watching. Here's an example. This person sits from market open until market close, watching every once in a while, even after market hours, trading full time. And yeah, that certainly is a full-time job. And if you can make it work, again, why not? But a lot of people, probably most people, just don't have a schedule that can accommodate that. So the third barrier would really be us. We get in our own way. We are human after all, and fear and greed, the two biggest emotions when it comes to money. We end up on that emotional roller coaster, as we like to call it. You're a genius and euphoric when you're making good money, and then you're despondent and depressed when you're waving that white flag of capitulation and surrender when you're not doing so well, and then you go back and forth on that roller coaster. So we need to learn to control our emotions if we're going to have any chance of success at all in trading, regardless of your approach or strategy or tickers that you're trading. Because, for example, your competition isn't someone like yourself on the other side of the country sitting behind their computer. It's really machines and automation, high frequency trading, systematic. You have these algorithmic trading machines and so forth, institutional. So that's really what's happening. 70% of the markets in the US here, stock market volume is algorithmic and only growing. So what can you do, and what do we do knowing that we're human? How do we compete with that, systematic nature in those machines? So we can use option strategies that are algo driven, and we're going to show you that in just a second when we jump into our demonstration. And we're going to first learn what strategies you might want to use. So why don't we try to emulate or mirror what large institutions trade like and what the professionals trade like. And sort of here's an analogy. An insurance company gets paid premiums, they sell time, they insure themselves, they're consistent and they're patient, and they use math and probabilities. We're all familiar with actuarials and statistics and so forth, and that's really what an insurance company is doing behind the scenes, collecting your premiums and betting against events not happening. And if they do happen, they've made enough money along the way. So that's kind of tipping the odds in your favor. What's the name of that movie that's from? Which maybe someone can remind me. How come I can't recall the name of that movie? Anyway, uh, we can collect premium too, like the insurance companies. And we need to manage our risk and reward. We need experienced people to help us along the way, at least get started. And we're going to use the correct tools in our toolbox for automation. And when you collect premium, you're looking for lots of base hits. You're not looking for grand slams. These are short option strategies or premium collection. They can be non-directional and bullish or bearish. It doesn't really matter. These strategies are flexible. So every trade has a targeted outcome with fixed risk. So you already know in advance before you get in there. So Wall Street pros trade multi-leg option spreads, and they're collecting premium too. We'll get back to this woman in just a minute, but she says here an option spread calls for buying and selling different contracts. It's a common way for investors to hedge risk and volatility, and it's usually cheaper because you can offset your cost by the proceeds from different contracts. And she's absolutely correct. Then she mentions here this strategy has been used by Wall Street professionals for decades. So before we jump in, we're going to learn two letters of the Greek alphabet, help us determine probabilities. The one here is delta. And the definition is how much does the option value change with the change in the underlying asset? So it's also the approximate probability of expiring in the money when we're speaking of options. So if a delta is at 0.25, that means at that moment there's a 25% chance it expires in the money, but conversely, a 75% chance that it would expire worthless. And remember, delta is always moving with price and time. It is not a static metric. And this is important too. It is not the probability of a winning trade. So we're going to talk about that in just a moment. And then theta, this is the other letter of the Greek alphabet here. That's sensitivity to time. Remember, options always have an expiration date, so they always end up with 0 time. So theta measures time decay as a negative number. So for example, if an option has a premium of 10 and then theta is negative 0.05, that means the next day, all things remaining equal, the premium drops to 9.95, and then the next day after that, 9.90, and so forth. And then as you get closer to expiration, theta decay actually starts to accelerate a bit. As you can see, with a lot of time, you still have a lot of time value, and then you're losing more time value and more time value, and then before you know it, you're down to 0. And option spreads, let's take a look at a couple of examples. Selling a call spread, and this happens to be on the E-mini S&P 500, and we'll show you why we look at those markets. But selling an out-of-the-money call spread, it means you're either bearish or maybe even moderately bullish or non-directional. So here's what it might look like. Here's your call spread here. The red line means you're selling or going short the 64.10 call, and you receive 4.5 points. So someone's paying you 4.5 points. You put that money in your pocket, but you want to hedge that. You don't want to be short naked call. So you buy a further out of the money call, in this case, 64.30 strike, and you have to pay some money for that insurance. But the net result is you still collect a net result here of 2.25 points, $112.50, minus any commissions. And so you place that out of the money call spread, you collect that premium, and you see in this example, the market's moving along sideways and up and down, and it comes down a bit. And then at this point here, this vertical line is where you would then close out that position before it expired. So you sell it high for, in this case, $112.50, and maybe you buy it back for, oh, I don't know, $20 or something like that. But we're going to get into some examples. Here's another example of a put spread. It's just the inverse of what we looked at. I won't spend a lot of time, but you're selling this out of the money put spread, and then at some point in the future, you'll close it out by buying it back, hopefully for less. And here's an example of a condor. It's called an iron condor. It's a non-directional strategy, and it's a combination of the put and the call spread we just saw. You place the orders at the same time. You're not going to leg in. So you sell a call spread and you sell a put spread simultaneously. And you can see here is in this case, the market kind of chopped around. And then what happens after theta decay, or as time goes by, you can see this blue arrow here and the arrow here and this blue box. It's called the RTI, or the risk thermal indicator. So this is a color-coded system that we use with our software. It tells you when to close out your spread positions. So you sold it here, market moved around, and then you bought it back and closed out your position. In this case, it would have been for a gain. It's not always a gain, of course. These are not guaranteed winners, or don't want to make it sound like that. But you can see here is the expiration date here. So you're always going to close these out before expiration when you're trading with us. And then here's the dragonfly. So this is 6 legs, and it's a variation on a condor where you collect premium on a net basis. And again, you're not legging into this. You're doing this all simultaneously as one order. And I'll explain the structure here. No, I don't know what happened here, folks. Hold on a second here. My PowerPoint just went off on me. So give me just a second here. I don't know how that happened, but bear with me. Talking about glitches, there's one for you. Sorry for the delay, folks. Actually, I should have just gone directly to the slide, but anyway, we'll get there in just 10 seconds. And we were just starting to look at the dragonfly. So coming up here. Here we go. All right. So you have this structure here where you're selling 4 of these calls. You buy 3 further out of the money calls, and you buy 1 closer to the money call. And you do the same thing with the put, same structure. You sell 4, you buy 1 closer to the money, and you buy 3 further out of the money. And you'll notice this one that you buy here, in this case, is 50 points closer to the money compared to the 4 that you sold. And happens to be the same thing here with the calls, 50 points closer to the money with this one you buy. So that completely changes the dynamics and the risk reward characteristics of this trade, because the market starts to drop a lot. This put here that you own will start to gain in value more rapidly than the 4 that you've sold, because the delta is higher. And theta decay also won't impact it as much in terms of an adverse movement. But so what happens here is after theta decay, in this example, you see the market moves around. Then right here, you get a signal that's a profit-taking signal. And then this is where you would close out the trade. And you can automate this as well. So we're going to show you how to do that, where you don't have to screen watch. Automation will take over, monitor your account. And when you get these profit-taking signals or a risk signal, which is red, then an order is placed for you to close out that trade automatically. And stick around here in just a few minutes. We're going to show you a trade alert, how to accept those as well. We're going to show you that in just a second. And it's not just non-directional strategies. You can use unique bearish and bullish strategies as well. Here's something called a bull hedge or a bear hedge. And it's probably better just to show you. In this example, what you've done here is you bought an out of the money call spread, and to pay for it, you sold an out of the money put spread. And you can usually do that for even money or sometimes even a credit, or it might cost you a little bit. But the great thing about these trades is you can do these without really very little upfront cost. And in this case, the market rallies, and a trade like that would do well. Of course, if it went the wrong way, you'd have to cover your risk on the short put spread. And here's a bear hedge, just the inverse of what we just looked at. But here's the question you're probably asking: how do I know where to begin? What am I buying and selling? What market am I applying this to? Which strategy? What is my timing? My entry price? And then how do I manage the position once I've got it? It can be complicated. Here's just one expiration. You can see all the different permutations and combinations and possibilities when you're looking at options trading. So Theta Trader is our answer. These are pre-built option spreads. Our proprietary algorithm will create what we call theta trades on a daily basis. And these are also going to include these one-touch responsive trade alerts, which of course will show you any market condition, it doesn't matter. And then we'll use the automation with the RTI for the risk and the profit tracking. So what I'll do here now is I'm going to switch screens. Okay, so now we're looking at my dashboard for Theta Trader. And I will explain what this is all about here. This is a demo account, so there's a few things different here, but generally speaking, your menu would look, similar. And these are any active trade alerts for the day up here. And these are the theta trades for today. And you'll notice there are bullish strategies, bearish, and neutral, as what we call non-directional. And we're trading 3 particular markets: the E-mini, S&P 500, NASDAQ 100, and Russell 2000. And primarily speaking, we're doing that because that's where all the volume is. And if you're not trading these markets, you're missing out on a lot of opportunities in terms of the ability to get trades executed really with very, very little slippage. You've got the bid-ask spreads that are very tight. And we'll show you some details about that in just a bit. And then you'll see down below your open, sold or short positions. So these are just positions that are in this demo account from other presentations and webinars and demos that I do with clients or whatever it is. So these are just here randomly sitting in here as open positions. And these are open long or bought positions right here below it. And you'll notice all the different colors, and I'll explain that in just a bit. And here's the account information. And this is connected directly with your AltaVest trading account. So ThetaTrader is our software product that we created for all of our clients to use at AltaVest. So to have access to ThetaTrader and to use ThetaTrader, you need to have an account with AltaVest. So I want to make that clear. I get questions about that a lot. So here, what we've done is, since we looked at the condors and the dragonflies, we'll take a look at the dragonfly for today. Here's the July week 3 expiration. I typically just choose the one with the most days till expiration in these demos. You can see the strike prices are pre-selected. This is your maximum profit potential at expiration, and this is called the targeted annualized return at expiration. And it's there to compare one trade to another. So you can see this has 33 days till expiration and 35 and 37 and so forth. So obviously you can't always expect to make a 71.48% annualized return just by placing that one trade. But it's really there just to compare one expiration to another. So you'll see this is what this trade looks like, and the algorithm has all filled it out for us and pre-selected it for us based on various you could say secret sauce criteria behind the curtain. But here's what the chart looks like. So here's the current market. Here's the calls that you're trading. Here are the puts that you're selling. Remember that selling 4, buying 3, and then buying 1 closer to the money. And in this case, the one you're buying is 50 points closer to the money compared to the 4 you're selling. And it's not always 50. It can be more or less, but that's just the way it is at the moment. You see all the data for your days till expiration, expiration date, settlement value, put risk, call risk, commission, capital, cash required, maximum profit potential, targeted return on cash, and your targeted annualized return. And then here's what I can show you here as well. So you are selling these 4 puts and you're selling these 4 calls. And then the rest of these are long positions that you're buying as a hedge or protect the short puts and calls. But the net result is you're trying to collect just over 9 points. So after all that is done, and this is after commission, by the way, so the net result on all of this in terms of dollars. So let me show you, people ask this. I'm putting up $4,631 and I have a maximum profit potential of 368.50 in this case. Well, that just happens to be for the moment. Other trades are going to look a little different. Some might have double that profit potential. It kind of depends on various factors, of course, where your strikes are, what the volatility is in the market. But that's where it is right now. But why would you do that? Why would you risk 4,600 and put that up as your cash required to make a maximum of 368? And even then, that's not realistic because we're going to get out of that trade before you reach your full maximum. So, well, here's the answer. The delta is 9.44 on the 4 puts that you're selling. So you have over a 90% probability mathematically that these puts you're selling to someone else are going to expire out of the money and in their hands and not yours. And then same with the call. Just about 7% probability here that these would expire in the money. So that means there's 93% probability that these calls you are selling to someone else are going to expire out of the money. And that's the reason why the algorithm has chosen these higher probability outcomes. And you could change the strikes if you wanted. I wouldn't recommend it, but you could. And because you're selling or trying to collect net premium, it always defaults to a quantity, a sell here. You're selling the spread. Always defaults to a quantity of 1. If you raise it to 2, you see the cash going up, or 3 or 4. We'll go ahead and do 4 of these and then place that order. Just assumes we're filled on a demo account. So it's just that simple, folks. In terms of placing an order using the dashboard on ThetaTrader. So you took an order that would have been very complicated to try to create and build on your own. And ThetaTrader just generated that order for you and then allowed you to kind of view it and make any adjustments to the quantity that you wanted, and then place the order from there. So let me show you a really great feature as well. It's called a trade simulator, and I've loaded a few trades here already. And let me squeeze down the screen. So we can compare the Dragonfly to the Condor. So here's a February end of month iron Condor. And then these are tools down here to go forward in time and backwards in time. So let's assume you placed this trade on, I guess this would be January 15th. You can see the date here. It had 45 days till expiration, and we'll just play through it. You can see the yellow RTI. That means slightly elevated risk, but don't do anything. And the green RTI means good, do nothing. Now you can see the trade is not quite profitable yet until about right here, 22 days till expiration, because theta decay is starting to work. So all is well. And then you get a blue RTI, and that means take profit. So with 8 days remaining till expiration, you get an RTI that says close out the trade, take your profits, and move on to a different trade. And you can automate this as well. Remember, I'll show you how to do that. So you don't have to watch this Theta Trader scanning your account, and it will place that order for you. But remember that date here, 8 days till expiration, you have a profit-taking signal. Now let's look at the February end of month Dragonfly. So you placed a Condor and a Dragonfly, and let's look at the difference. You still have some yellow days, which is all fine. Nothing to worry about. And then you get a profit-taking signal here with 22 days till expiration. So, you're looking at, 2 weeks earlier, this would allow you to place that order and get out of that trade well in advance of the Condor. So that's a big example or a big difference in the Dragon and the Condor at times. Not always, but the Dragonfly will sometimes mature much more quickly. And that's because you own this call here compared to the 4 that you sold. So it's acting as a hedge, and it's not losing theta decay, or it's not losing its value as rapidly because it's closer to the money. So here's another one. Let's show you another example. Here's an iron condor. So it's losing money, and that you can see why, because it's starting to rally pretty strongly, getting close to that short call spread there. And now it's getting more profitable, but still do nothing. Turns orange, so that's even more elevated risk, but still do nothing. But then finally you get that red RTI. Too much risk, close it out, and again, you can automate this. So this would have been a losing trade. But let's look at the same thing, the July week 3, and let's assume we were trading the Condor at the same time. I'm sorry, the Dragonfly. So you can see here the trade was negative P&L, but the green RTI is good. And then you actually have profit-taking orders here being submitted with 22 days till expiration. So completely different risk profile here and reward profile compared to the Condor. So the Dragonfly trade turned out to be a nice profitable position compared to the Condor that actually didn't mature yet and ended up being a losing trade. So we love the Dragonflies. Not to say we don't do Condors at times, but just want to point out the difference with the Dragonflies and the Condors. You see the expiration date here, and then it finally gets triggered, um, with, well, about 22 days till expiration. Now here's a bear hedge, and I just chose this to give you an example of what it might look like if you had a bear hedge on when the April stock market, let's just call it pullback occurred. So you would sell this out of the money call spread, and you would buy the out of the money put spread with the money you received. Clearly we all kind of know what happens, but so it ends up basically with a a maximum gain on that spread. And that's just kind of an example of how a bear hedge could help if you have a long stock portfolio, and you might want to have some other positions that are providing a bit of a hedge. So that's why we call it the bear hedge, but you could use it just to speculate. So you go under My Account, under Settings, and this I'll show you here is how you activate the profit directive and the risk manager. Right here, you check that box. And then you can choose what is your default, your setting for your risk manager. The default setting is a red 50 delta, the orange is 0.38, or you could do a custom number. So you can go anywhere from 50 to 25. But keep in mind, if you lower the risk threshold down, say to 0.25, that means you'll have more frequent losers, more frequent losing trades, but they will actually be smaller in magnitude. So I just leave it at the default level, and then you would click Save Settings. And the same thing here, activating the profit directive. So whenever it turned blue, and then you click Save Settings there, and you click your Save Settings here, and that's how you do it. So it's real simple to do that. Want to point out too, we have daily research available. In fact, before I do that, well, actually, no, let me show you that. It's called TradeScope, and I opened it up here. And this might be actually interesting to just kind of take a look at. What are the triggers that you're using to actually place these types of options trades? And here's TradeScope that we do. And sometimes, there's more involved than just looking at a chart and a few indicators for us. But there are times where you have a signal like on, let me see here, if I can find it. Well, here's actually a good example, almost starting to happen. But if you're looking at two consecutive closes outside of the Bollinger Band and a deeply, deeply oversold RSI. I mean, RSI was down around, I don't know, 17 or something down here. So you have two closes, one here below, and the next one, below the bottom of this Bollinger Band. So maybe at this day here, you would have decided, I think the market at least could start to consolidate. It doesn't have to rally as hard as much as it did. That's not necessarily what you're anticipating, but at least it might have to, it could chop around a bit, and that could give you a chance to sell some out of the money call options. I'm sorry, out of the money put options, or you might think it's going to consolidate. You might place a dragonfly. So that's kind of one of the things, real simple, but you get these extreme overbought or oversold conditions. Doesn't mean a market can't continue, but it might be a good point to consider some of these out of the money call and put spreads that have a wide margin of error. That's another feature. It's not going to necessarily impact your P&L tick by tick. So just pointed that out. Here's something also we do call a daily commentary, looking at what's happening in Asia and Europe, looking at what's ahead on the calendar, economic calendar. So it's a real, 2 or 3 minute read. People love reading that, kind of catching up. There's a great help file here as well, right under the help menu. And this is helpful for people if they want a glossary of and a description of the color coding. It's all here for the RSI and also all the different strategies. And there's also a great menu of items here and videos for how to do everything you need to do in ThetaTrader. But what you saw me do already is very, I guess you could see it's very intuitive and user friendly anyway in terms of the interface. So, but you can see there's little 2-3 minute videos for how to do all this. There's videos on education. It's all included as ThetaTrader as part of your ThetaTrader usage. All right, and then we'll go back to this page here. Remember we talked about these trade alerts. So you see if you get a trade alert sent out, it'll show up on your dashboard, and then you click view. So here's what it looks like. And there's a description of the trade alert here. Shows this one has 30 days till expiration. There's a little pop-up menu there explaining it. You'll notice here a detail of the spread trade here. We're just selling an out of the money call spread right now. And you're trying to collect this amount here. based on this quantity. You can always lower the quantity if you'd like. You cannot raise the quantity beyond the amount that was sent to you by default. And remember too, each alert that you receive is customized for you. It's tailored to you and your account size and whatever other elements or trades you have in your account. So you're getting alerts that are specific to you and your account. You won't receive the same trade, every day, for example, as an alert. And the quantities are pre-sized based on your account size. So all you have to do if you see that coming in, you just touch accept and just assumes you're filled. Here's the other alert here. This is selling 20 of these call spreads. And I'm sorry, that was the call spread. This is the Dragonfly for today. Again, the quantity is pre-selected at 7. Maybe I'll just for kicks go down to 6. If you don't like it, you can just touch reject, but we'll go ahead and just accept that. And there you have it. So it's that simple, folks. Let me go back. So there's a good rundown of ThetaTrader and how to use the dashboard and the platform. And if I refresh, you'll see that the alerts have disappeared because you've already accepted those. And there is let me go here for a second here. There is a section here where if you wanted to start fresh and build your own trades, you could. Some people do use this, choosing your strategy and your market, and then you just kind of go forward to the next page and so forth. I didn't choose anything there. So anyway, there you go. But quite frankly, most people are just using the theta trades and the alerts. That seems to make sense because that's what the algo is doing for you, doing that work for you. So you could, change some of the strikes if you wanted. And again, too, we're not just doing dragonflies and condors. You've got all these different bearish strategies and bullish strategies that are pre-populated as well. Okay, so let me show you how it looks and what it would look like if you're getting the alerts on your phone. That's kind of what I think most people really like. Well, I know for sure, kind of stumbling. I know for sure that most people like receiving the alerts on their phone because who doesn't have a phone with them typically, most of the time at least. So let me switch screens here. And what you'll see, here's an example of what it looks like. You receive an alert. You'll get it via your dashboard, via text message on your phone, and also via email. And then all you have to do is touch accept or reject on any of those mechanisms, I guess you could say. So all of these alerts, again, are live and they're integrated with your account. So if you touch accept, then that order is going to be placed for you or reject, and it'll be rejected. So here's what it looks like. An example, you'll get a text message and it's a link, and you just touch that link. And it will take you right to the alert page. And this might look familiar. So in this case, here is a dragonfly alert, quantity of 9. And again, you can change that quantity only by lowering it. You can reduce your risk and exposure, but you can't add to it. So there you go. It's telling you that you're selling 9, that's your entry price, how much you're trying to collect, your cash required, 52 days till expiration. And you like what you see, and you just touch accept, and the order's placed. So it really is convenient. Let's just say that. And once the order is placed and filled, then ThetaTrader will monitor it day by day, and whenever it turns red or blue, whichever occurs first, too much risk or enough profit, you'll have orders placed automatically for you to close out that position. Okay, so we're doing well here, and I think we're past all those glitches. So here's how to get involved and get a ThetaTrader lifetime membership. I want to clarify. You sign up with us, and this is for your lifetime membership. So you'll obviously get everything we just talked about, everything we saw. The ThetaTrader software includes all of the theta trades every day, your risk thermal indicator, that's the blue and the red, profit and risk monitor, and then that trade simulator. You saw how great that was, going backwards in time and being able to look at various strategies and how they would perform. So that value over $3,588. Remember too, these are six-legged option strategies that you can back test. So very, very unique. I've never seen that anywhere else. And I think I've seen, all of the really uh, legit, valid platforms out there, but I could be wrong. Maybe someone can tell me if I'm wrong, and they've seen six-legged strategies like that. But these are trades tailored for you, and they're live, meaning they're integrated with your account when you just touch accept and the order's placed. So that alert strategy there, valued at over $4,400. So that Theta Trader membership includes everything we just talked about, the software and the alerts. That's part of it, valued at over $8,000. But I think what really distinguishes us is we're not just kind of setting you loose on an algorithm or trading with software. We are real people and we offer our private coaching along the way. So your interest is in our best interest. And if you do well, so do we. So we'll have these 1 hour or half hour or 20-minute, whatever you want to do, screen sharing sessions or however you want to do it. But we're all licensed and experienced. So we can be your co-pilot and develop that relationship with you, discussing your trade strategy ahead or looking in the rearview mirror too, kind of learning from the past, valued at over $7,500. So you have the Theta Trader software, the alerts, the coaching, and valued at over $15,500. And I know a lot of people spend a lot of money on training and coaching and education, and that may not be a bad thing because there's a lot of great information material out there. But what we're saying is that's included in your Theta Trader membership. And I did mention the proprietary research, so I want to point that out as well. That could be a real big help to you. And that's only available to our Theta Trader clients, valued at over $2,900. And the online tutorials, that is just part of the Theta Trader package here. So remember, this is a lifetime membership, including everything you just saw, valued at over $18,500. But of course, that's not what we're offering this at. And our live in-person events, we have this offered at $4,000. And our retail price on our website, if you go to our website, basically this is what you're going to find. So we're going to do much better than that. So this is for our timing research event. We're going to do half off of that, $497. And here is the link, cf.altivest.com/TR. This is a simple order form page here. That's my direct phone number and email address if you have comments or questions beforehand, but it's just that simple. And really, there's no excuse or no risk on that membership fee because you get a 30-day guarantee, but you also have a chance to get it fully rebated. You have an account of 100,000 or more, we'll rebate that 100%. Your account's 25,000 up to 100,000, it's a 50% rebate. So you fund your account within 30 days, start trading with us, and we'll rebate that membership. People love that offer. And I mentioned the money back guarantee, 30 days. So sign up with us, and something changes in your life and you just can't move forward, we'll just rebate that membership fee to you. Really no trouble at all. So you don't have any excuses, and I think we can provide something very unique and very useful to you at a great, great value. So a few FAQs. Why the E-mini futures options? Well, they're liquid, they're efficient, they're cost effective. Average daily volume approaching 1.5 million in 2024. I think it just keeps growing. So that's on the E-mini S&P 500. CME Group did a study compared to the SPX. Those options offer superior execution and the cost savings of $4 to $15 per contract. So you get those tight bid offer spreads is what they're really getting at. And that means you have deep liquidity across a wide array of maturities and strike prices. CME Group here points out they have densely packed strike prices available and 100 annual expirations. So you get granularity and coverage. So what that means is when our algorithm Theta Trader needs strike prices and expirations to build out the next trade, it's going to find them. So here's some call spreads and put spreads, and time goes by. Here's another set of call spreads and put spreads, and so on and so forth. So that's very, very important. You need liquid markets to make this work. And this is where volume, price discovery, and technical levels occur in the S&P, on the E-minis. And did you know, this is interesting, about 10 times the value traded across all the S&P 500 ETFs. So the E-mini S&P 500 futures, about 10 times the value compared to all S&P 500 ETFs. And this is something you may not have considered. There are no pattern day trading restrictions when trading with us. So, that means you get additional regulatory scrutiny, and there's limitations on what you can do when you're identified as a pattern day trader when you're trading in securities. That means if you've executed 4 or more day trades within 5 business days using the same account. So that would apply to a lot of people. And then also you get prohibited from making further trades if your account value drops and so forth. So you're on the radar when you're trading securities and day trading, but they don't have that in futures options. So, and there's efficient margin compared to securities. There's tax efficiency. Speaking of efficiency, so they are tax efficient according to the 1256 contracts. That's what the IRS calls them. I won't go into this detail here, but if you're trading futures options versus a particular securities option, you're going to have a tax savings, and that's because your gains are taxed at the lower 60%, I should say, of your gains are taxed at the lower capital gains rate. So that makes a big, big difference. And there's also no more itemizing. You get a 1099 with one P&L, one figure, and that's all you have to do. No wash sales or anything like that, but always consult your tax attorney or advisor. And IRA, yes, we can do that. People transfer those self-directed IRAs all the time. And I also want to point out when you're doing Dragonfly with us, that's doing one trade at one price, one order. So we're not legging into one side at a time. If you try to do a Dragonfly with a particular stock option, you're going to have to break it up into 2 separate spread orders and leg in and leg out. Not efficient at all. So these are very sophisticated option strategies that you have access to versus some of the retail stock options traders don't often have access to the more sophisticated strategies. So here she's talking about retail stock options traders only having access to the most basic call and put option strategies. And they don't have access to option spreads or more sophisticated strategies. And remember, the pros are not just buying options. You don't want to rely on that. That's what rookies do. It's really the worst strategy to rely on because theta decay doesn't help you. It's actually working against you. And she points out here that's a popular trading strategy, but it's also risky. So the appeal for retail investors to only buy options is that they're much cheaper, but your potential for profit is actually not that high. That's because the probability of success is not that high, is what she's saying. And here's an interesting fact. 2021, 11% of Robinhood's accounts, active users, they traded options, but of that, fewer than 1% actually made in a multi-leg options trade or a spread trade. So again, advantages to doing the E-mini futures options with us. You're tracking 1 or 2 markets, not thousands. Efficient margin, clear cost structure. There's no payment for order flow if you don't know what that is. Basically, it means when you're trading orders, trading securities, the orders are getting sold to a third party to fill those orders, and they pay for that order flow so they can fill the order and take a bigger piece of the spread at your expense. So that's what that is. So there's no margin calls also when you're doing covered option spreads with us. So no naked options trading. We don't allow that. And that means there's no unlimited risk and you don't have margin calls. So you'll never see this as an incoming margin call if you're trading according to the way we just looked at with Theta Trader. And you don't want this here. Who is margin and why does she keep calling you? You'll never have that happen to you. So that's why we do covered spreads and we get out before expiration. The rates are 5.25 round turn all in. That's inclusive of everything. Uh, Here's a big box brokerage firm just from a few months ago. They have rates published at 2.25. Um, but that's per side, and there's more fees on top. So it ends up being higher than what we charge. So our rates are very competitive. And again, I mentioned earlier, calculations are net of all trading contest costs, I should say, trading costs. And everyone has different results with Theta Trader. Every account is self-directed, so everyone decides to trade differently. And again, you've got the IRAs, individual, joint, corporate, LLC, trust, all the above. Why would you want to consider Theta Trader? It's really an alternative asset class, but you call absolute return. It doesn't rely on the market always going up is really what it amounts to. So it may improve diversification and lower your portfolio risk. And, keep in mind, stock market drawdowns can last decades. I mean, we've kind of been in a unique situation here since really 2008 and 9 when the Fed lowered rates to zero, and that's just been juicing the markets ever since. And anytime there's a big pullback, it just gets juiced again. But history shows us that's not always so common. In fact, you don't have to go back too far. Look at 2000 here, the dot-com or the tech bubble. The NASDAQ dropped 80%. So if you were unfortunate enough to buy near the highs, it took 15 years before you recovered if you just kind of sat there and held it. So that's probably not a great investment strategy. So that's why we like having access to an alternative like Theta Trader. It's nimble, it's flexible, kind of has a low correlation. That's what alternatives are all about. And we mentioned the word absolute return, or it's non-correlated to a benchmark. So what that means is any of the strategies we looked at today, mostly these non-directional strategies I showed you, as well as these bull and bear hedges and whatnot, but they're not relying on the market to always move higher. They have a mind of their own, shall we say. So we can review the benefits here of the E-mini option strategies. So strategies for any market condition. Premium collection offers that wide margin of error. We think the convenience and automation saves you time. And then it helps, I think, to diversify what you're doing in your traditional assets and maybe even hedge with the non-correlation of these strategies. And then the one-touch responsive trade alerts are incredible. We get a lot of great feedback on that. And you have the bull bear non-directional strategies. So we're not day trading. We're not trying to pick stocks. You don't always have to choose up or down. You don't have to try to do this kind of analysis here. But yeah, this is true. The stock market will fluctuate. That's for sure. We mentioned the wide margin of error. For example, you had 1,450 points between your short calls and short puts in this dragonfly. So you look for theta decay to work in your favor within that wide margin of error. We think we can save you time. This guy here or gal says he's working 10 to 12 hours a day consumed with trading. So it's probably not feasible for most of us. Again, diversifying into alternatives, that absolute return element. You don't want your portfolio looking like this or this. I think it makes sense to have that gray slice of the pie. In this case, they mentioned 20% alternatives. It can be whatever you want, but I think it probably should be something. So you can use that slice there to additionally speculate and maybe even hedge your stock portfolio. And then those one-touch responsive trade alerts, you just touch that accept button, that green button, and your order is placed. It's that simple. You can do that via your dashboard, via email, or on your smartphone. And this is what it looks like on your dashboard. Here's what it looks like with an email. You get an email, you just click the link. And then, of course, you saw what it looks like on your smartphone as well. You just touch that link and it takes you right to the alert page. You can lower that quantity if you'd like, and then you just touch accept. So that's a good summary of Theta Trader and what it can do for you. Algo-driven spreads, automated trade exits with that color coding and the RTI, and then those integrated trade alerts are one-touch responsive. And then to wrap it all up, you get that personal coaching as well. So you get signed up, and this is what will happen. You'll complete you sign up with the order form here. You can see that link. You'll get your ThetaTrader login credentials soon after, and an email with a link to start opening your account. And then once your account is open, you'll fund the account and then begin accepting live trades. And so that's what it looks like, folks. You just go ahead to the form, click complete your membership. That's our special offer. And it does expire. We don't keep these offers going all the time. Let's see if I have any comments or questions. Let's see here. Okay. Yeah, someone asked about cash required. That's correct. Cash required is basically covering the possibility of a maximum loss. So that's correct. That's a good question. So that's the worst you could lose on that trade is what the margin requirement is. So that way you can never have a deficit or never have a debit or never be on margin call. So that's a good question. And yes, you would have an account with us. So if you have another futures account somewhere, you can transfer that account to us. Um, but if you just want to start with a new AltaVest account and fund it with cash, then you can send a bank wire or we do ACH transfers. That's usually the best way to do that. So that's a good question too. And then if you have an IRA to transfer, then we work typically with Midland Trust and others as well as the custodian. So you'd have sometimes people call say I already have an account with them, and so it's just a matter of getting your AltaVest account open and then getting that paperwork sorted out. Okay. Someone is asking about trade your actual the trading results. Again, I mean, it's not a system. It's not we're not managing money for people. So it's just like asking E-Trade, what are your results? I mean, they have clients that do all sorts of different things and the results are all different. So there's no answer for that, but I understand why you're asking. But again, we're not managing money. And this is a tool to allow our self-directed clients to place their trades. And you get people doing all sorts of different things. So, but that is a good question. And people always ask, I'm in Canada, can I do this? Unfortunately, you can't. Regulations are such, you got that protectionism, and that just doesn't, they just don't do that. They won't allow us to trade with Canadians. So sorry about that. And other than that, I think that's going to wrap it up for me, David. But call me. I've got my number there. Take a screenshot, um, save that link, and we'll go from there. So that's going to wrap it up. Thanks, everyone.